Our question today is, Michael, how can you get higher returns on single-tenant net lease investment properties? Well, these are usually referring to properties with one tenant, and they have long-term leases. They're triple net, meaning the tenants are paying taxes, insurance, all operating expenses of the property typically. And these cap rates or cash-on-cash returns can run anywhere from 3, 4, 5, 6, 7% typically, depending on the tenant and the area. And some investors would like to get higher returns. Here's a few ways to do that. One, if you're comfortable with the real estate and the tenants possibly renewing the lease, then you can look at properties that have a shorter lease term. Because of the risk of the tenant renewing or not, they're going to sell cheaper, have a higher cash-on-cash return, and higher cap rate. Another way to do it is to look at what might be considered non-credit tenants. So it might be a great company with great credit, but they're not a BBB rated company. So they might be a local or a regional tenant, and so they have great credit, they're going to pay you, but they're not as considered as safe as the national credit, BBB type rated tenants. So you can get a higher return. The example might be a local company that's a real estate company or an industrial company user. We sell a lot of industrial properties that have business that has 1 or 2 locations. They're great tenants, they've been in business a long time. You're going to get a higher cap rate. You might get 7, 8, sometimes you get 9. We've seen some at even 10% cap rates on some of the smaller properties. And the other benefit of how you can get higher returns on those more local tenants is that you might not be overpaying for the real estate. In other words, if the tenant did go toes up, you're at a rental rate that you could re-rent that very quickly and very easily, or you're at a price that you paid for it that is not more than the property is worth vacant. What I mean by that is you might buy a CVS or something like that with a 25-year lease, and you're buying that based for that income stream. But if that tenant wasn't there, that building's probably not worth what you paid for it. Some of these Dollar Generals, some of these dollar stores are the same way. I mean, you might be buying in a small market where if that tenant's not there, that building in real estate's worth $200,000 or $300,000. But with a 15-year lease, maybe it's worth $900,000 or $1 million. But with a more local tenant, hopefully you're paying a rent. They're paying a rent that you could re-rent it easily. If they went toes up, you could sell it. So naturally, you're going to have more price appreciation on that property because you're buying it at market. If you'd like to know more about that, give us a call. We'll also provide some links below to some shows and articles we've done on single-tenant net lease investing. Enjoy and prosper.
Ask Michael Bull is brought to you by Bull Realty, Commercial Real Estate Advisors, Xceligent, Commercial Real Estate Information, and the Commercial Real Estate Show. To access these companies, as well as additional videos, podcasts, and articles, visit CREshow.com.